Welcome to the Explainer. Forget surface-level profits. Today, we're running a financial X-ray on true operational health.
You see massive profits, right? But hey, is that really enough to prove a business is totally secure?
The reality is, sky-high profits built on dangerous debt, that's literally a massive hidden trap for us.
So, let's dive into our first vital sign. It's efficiency, measured by a company's asset turnover. Think about two identical machines. The one pumping out 5 times the sales is obviously way better.
It's exactly like the Uber model. Squeezing more rides out of one car means insanely high asset turnover. But man, look what happens when that efficiency totally breaks down, kind of like it did for Symphony coolers.
For every single rupee of asset, their sales plummeted from 130 down to just 67 paise.
That drop means either their sales fell off a cliff or they built a completely unused factory.
Next up, the company's cholesterol, the debt-to-equity ratio. This bad boy reveals the true financial risk.
Crazy enough, piling on debt can artificially inflate a company's return on equity, totally masking the danger.
Like using half debt might show a 28% return compared to just 20% without it.
But here's the huge catch, guys. Interest has to be paid even if the company loses money.
And honestly, that's exactly why the ideal debt-to-equity ratio for us cautious investors is simply 0.
Massive wealth creators like Page Industries. They run with practically zero debt, completely minimizing their bankruptcy risk.
Now, if they absolutely must hold debt, our third metric, interest coverage, checks if they'll actually survive it.
Check out Tata Chemicals. They rake in 1,400 crores in profit, but only owe 108.
This literally means their operating profit is a massive 12 times larger than their actual interest expense.
With 12 times coverage, they can comfortably survive downturns and easily pay off those mandatory bank obligations.
As a super safe benchmark, you always want to see an interest coverage ratio of 4 or 5.
All right, so before you invest any hard-earned cash, always run this complete diagnostic X-ray on the business.
Verify their efficiency, make sure debt risk is super low, and confirm they can survive those interest payments.
Nailing these 3 fundamental vitals, that is your absolute key to safe, long-term wealth creation.
So, look at your own portfolio right now. Would your top stock survive this X-ray or just shatter?